Hey guys, Chris from Adapttuition here, and this is video number 1 in my ratios series. Okay, so I just want to give you a few words on what we use ratios for before we jump into the work. So I want you to think about when you guys would have had your test, your whatever's end of term or during the term, some people call it bi-monthly or whatever the case is. When you guys get those tests or those quizzes or those exams, usually when you get back results, sometimes you get a percentage, other times you get a mark out of a total. So those things are ratios, and they are used to assess and evaluate your performance on that particular subject or in that particular subject on that test. So we use those things as markers of performance to know, hey, are we getting better? Are we getting worse? Do I not understand this particular topic? Do I need to get help? Or am I doing pretty well in this topic? Maybe there's another topic or another subject that I'm doing not so well in that I may need to focus on a bit more. So the ratios tell us how well we are doing, and we make decisions on future actions based on those ratios, those percentages. For businesses, they engage in activities. Primarily, it's profit-making activity through the selling of goods or the provision of services, which earns them revenue, and of course, they have to cover their expenses. What is left over is profit. And of course, to whom does the profit go? The owners, because one of the major reasons that people start businesses is to make a profit. So profit making is one of the things a business should be assessed on. That's kind of why we are in business. We are in business to make a profit. So the question is, how well are we doing? Are we doing well enough? Are we not doing well enough? How do we know? So that's where the ratios come in. Now, before again I get into the calculations, I just want to let you guys know, and I'm going to bring this back around into context a bit later on in this video. A ratio by itself means almost nothing. It doesn't mean much. It's not very meaningful. It needs to be taken in context with other measures of performance, other ratios. For example, if you guys did one test and let's say you got 75% in it, is that good? Is that bad? How do you know? You might be thinking right now, well, yes, 75% is good. Some of you might be saying, yes, I wish I got 75% in most of my tests. Some of the others among you might be like 75%. I'm accustomed to getting 90, 95. So you see, good is relative. 75% in and of itself is not bad. It's neither bad nor good. It depends, all right? Suppose you were getting 50 something and 60 something in all of your previous assessments, and now you got 75. So that's an improvement, right? So you see how past information added context, right? Or suppose you were getting 90s in all your previous assessments and all of a sudden you got 75. Now that shows a bit of a deterioration in your performance. It decreased, it got worse. So the question is why? So ratios by themselves, again, are just calculations, relationships between two particular values, two particular figures, and by themselves, they don't mean much. They don't tell us much except the relationship between those two figures. We don't know if the company is doing better or worse at that item, whether it's profitability or any of the other categories. But in order to know that, we need more information. Now, at the CSEC level, the amount of analysis, the level of analysis required is relatively superficial. They want you to know exactly what the ratio means. They want you to be able to articulate it. And they do want some degree of ability to assess performance. Did the business get better or worse than its competitor or than itself 1 year previous? And can you make some recommendations as to how to improve the ratio? So in this video and the other videos on this topic, I am going to be doing a relatively low level or a light analysis. All right, so those of you who may be CAPE students will be watching, my plan is to do another series focusing on analysis at the CAPE level. Okay, so that's just to give you some context of what I'm going to be doing. Okay, so with that, all of that said, let's get into the ratios. Okay, so again, we're talking about profitability. So as you can see here, it says profitability. This refers to the ability of an entity to generate more revenue than expenses over time. So again, making profit is one of the primary reasons that we get into business. And again, as we are in business, we need to assess how well we are doing. We need to look at our performance. So this is a measure of financial performance. What is your profitability? So I'm going to show some more notes now. And again, if you guys want, you could take a pause and take a read. I'm not going to read it through word for word. I'll give you a couple seconds to pause and read if you want. Okay, hope that was helpful. Let's take a look at the 4 ratios that I'm going to teach you. Right, so as you can see, it says the profitability ratios that are used at this level include the following. So gross margin, net margin. Now, operating expense margin, and return on capital employed. So I just looked in the current iteration of the CSEC PoA syllabus. I think it was section 5, specific objectives 6 and 7. So they only had two categories of ratios, one of which is profitability, and they did mention the gross margin and net margin, but they also put another ratio which I usually classify in the efficiency or activity ratios, that particular category. And in the CAPE syllabus, it is there. So I think there's a bit of a disconnect between the CSEC level and CAPE level, unless my CAPE syllabus is obsolete, but I'm pretty sure it's not. Right? And there was actually this item, the return on capital employed, they put in the CSEC syllabus, they put that in the financial position ratios, in which they had the liquidity ratios, which will be a future video. Hopefully by now you can click a card up there or a link in the description to carry to the playlist. So I'm going to be consulting with some other accounting teachers to find out what exactly is going on, but I am teaching these as I know them. Again, if anybody has any feedback that could help educate me and bring me up to speed with new developments of which apparently I may not be aware, please leave it in the comment section below, and you could put your reference, your sources. I'll be happy to take a look, because again, as much as I enjoy teaching people, I enjoy learning as well, because as my tagline goes, change is the only constant, and to keep abreast of change, you have to keep learning and keep changing yourself. Okay, let's take a little look at a little mock trading account here, a little mock income statement, which will help us to understand what's going on profitability wise. Okay, so it says apart from the last ratio, all of the ratios in the above list use net sales as their denominator, or base figure as it is the figure from which all of the other figures come. So you're going to see this I keep wanting to say T account, but it's not a T account, it's an income statement. And you see net sales revenue, less cost of goods sold, that's gross profit. We're going to minus expenses and end up with net profit. Now you're seeing some arrows here. Now this 100,000, this is the sales, and that is, as is said in the sentence above, the figure from which all of the others come. That is the money that we use to pay for everything. Your revenue you earn is used to pay for your cost of goods sold, and it's used to pay for your expenses, and whatever is left over is technically used to pay your owner's profit. So it's out of the sales revenue, everything is paid. So the profitability ratios simply show each of those items as a percentage of net sales. So you can think of net sales as a whole pie, your whole pizza pie or your whole cake, and we're cutting up slices. So one slice will go towards paying off your cost of goods sold, and that will leave gross profit, right? The rest is gross profit, and then gross profit is split between expenses and net profit. So again, you can even technically ignore gross profit if you wanted, right? Sorry, I was trying to delete that so it would just get the 60, 30, and 10. But again, 60, 30 and 10 add back to give us 100. So that's where the 100,000 in sales revenue goes. That's where it goes. All right. So again, the profitability ratios, and I will show you the formula, basically express each of these items as a percentage of net sales revenue. And think about it. Again, if you use the analogy of cake or pizza, you kind of want more slices to go to the owner because you are the owner and you want more profit. But again, you need to pay for your costs of goods sold, you need to pay for your goods, you need to pay for your expenses. So some amount of your cake, some slices of your pizza are going to go towards the expenses, some are going to go towards your cost of goods sold. That's inevitable. You can't avoid that. Unless you guys could think of anything. If you guys could think of any particular way, any legal ways you could do that, let me know in the comment section below. That might be an interesting discussion to have. Okay, so let's take a look at the calculation aspect now. So the ratio up first is the gross margin, and the formula is gross profit divided by net sales revenue by 100, and the ratio is expressed as a percentage. Every percent is a ratio. It's a ratio with 100 as your denominator or base figure. It shows out of every 100 how much we got. But I think most of us know that by now. Now you're going to notice I have net in brackets here for net sales revenue. In some instances, they don't give us returns in order to be able to get net sales, and they just give us sales revenue. If that's what the question gives you, use that. Don't make it a big fuss, right? Now let's take a look and see what it says. What does this ratio tell us? This ratio shows the percentage of sales revenue left as gross profit after covering cost of goods sold. So like I was saying, if you have your pizza or your cake and you cut out your piece that goes towards paying for your cost of goods sold, whatever is left is your gross profit. So the gross margin shows the percentage of the whole cake or pizza that was left as gross profit after paying off your cost of goods sold. So of course you'd rather this ratio be higher as opposed to lower, because you'd rather more profit is left for you. And of course, don't forget, you still have to pay off your expenses before you get to net profit. Now, another way of thinking of this is that it shows how much of each dollar of sales revenue is left as gross profit after covering cost of goods sold. So that's another way to think about it. What portion of each dollar of sales is left after covering cost of goods sold? So let's take a look at an example and see how to calculate this thing, shall we? Okay, so in example one, which is Bing Nap Dingbat, we're looking at an income statement for a random period, doesn't matter. So we have net sales revenue less cost of goods sold is gross profit. So to find the gross margin, all we'll do is we'll take the gross profit of 2,000 and divide it by this net sales revenue of 5,000. So we're seeing that here. 2,000 over 5,000 multiplied by 100 is 40%. So that means that your gross margin is 40%. That means that after the entity covers its cost of sales, cost of goods sold, 40% of the net sales revenue is left. You can even think about it like the money in your wallet. If you get an allowance from your parents or whatever the case is, let's say you had $100 and then you had to pay, let's say, taxi fare, or you had to pay for, I don't know if anybody here still uses Uber, right? So you pay for that to go to your destination, and now you have some money left. It's like, well, how much money do I have left? What percentage of what I started with do I have? That's what this is telling us, right? What percentage do you have left to use? And alternatively, it tells us that out of every $1 of net sales revenue that the entity earns, it has 40 cents left to cover expenses and, well, net profit after it's paying for its cost of goods sold. So the gross margin kind of shows what is left to cover expenses and profit after paying for cost of goods sold. Okay, so that's the calculation. I'm going to show you guys another question now for you to practice on. This is Split Tax Incorporated, income statement for the period and blah, 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 blah. So I want you guys to do a calculation for the gross margin for Split Tax. So you could take a pause, take a read, and try it. Okay, did you try it? Let's plug in the figures. So we're going to have 15,000 divided by 25,000. Whoops, one extra zero, not needed. And that's going to give us 60%, right? Because 15 over 25 is 3/5, right? So just like across on the previous one, that tells us that 60% of our revenue is left as profit after covering cost of goods sold, which means that we only spend 40% of our revenue on cost of goods sold, which is pretty good, right? Now, again, good relative to what? If you think about it, let's compare it to Bing Nap Dingbat. So Bing Nap Dingbat had 40% of its revenue, 40% of its revenue left after as gross profit after covering cost of sales, whereas Split Tax has 60% of its revenue left as profit after covering cost of goods sold. So which company would you say is doing better here? Bing Nap Dingbat or Split Tax Incorporated? Probably Split Tax, right? All right. So you see, again, ratios by themselves don't really tell us much. They tell us what they mean, the relationship between the two figures in the calculation. But again, we use them to assess performance. And when we say assess, or maybe even you might prefer the word evaluate, it has to be assessed or evaluated relative to something, relative to a plan. Suppose Split Tax was a customer making 80% gross margin, and now it's dropped to 60%. So what's happened? Why did that happen? We don't know. Maybe they had to reduce price. Maybe Bing Nap Dingbat came into the dance and said, hey, what, we're going to charge lower prices than Split Tax, so just drive down some of their sales. And Split Tax, in retaliation, lowered their selling price. They still pay the same amount that they used to for their cost of goods sold, but now they're making less money on each and every unit sold. So their gross profit would go down. So again, I'm just spitballing here. I didn't come up with all of this when I made up the questions. I'm just going to show you that, once again, not having all of the information is a bit of a double-edged sword. It's bad in that we don't know the real reason behind any of these things, these movements, these ratios. But that means we can flex our brain and come up with ideas, good ideas, right? Now, not all ideas you come up with will be good all the time, but that's okay. You can refine them. All right, so don't forget, you could take a read behind my head there, right? What does that say? It says never stop questioning. Curiosity has its own reason for existing, and that's right, because remember, we need to keep asking questions to keep refining our understanding. All right, anyhow, so what I want to do now is I want to go down so we can check out the next ratio. Let's take a look at that one. Okay, so for the second ratio, we have the net margin, and its formula is net profit divided by net sales revenue multiplied by 100 over 1 and expressed as a percentage. So again, you can see the denominator is the same as the previous ratio. We just change the numerator. So this ratio shows the percent of sales revenue left as net profit after covering all expenses, cost of goods sold and operating expenses, and maybe some other expenses according to what level you are at. So another way of thinking of this is that it shows how much of each dollar of sales revenue is left as net profit after covering all expenses. So what percent remains for the owner? So your pizza or your cake, you've just sliced it up and you've given to your guests, and now you have left for you. So how much do you have left? Or if you're like me and you really like cake, you would rather have more cake than less. So what I was saying, so as an owner, you rather have more profit left for you than less. But of course, it costs money to make money. There's a cost of there are costs attached to doing business. So you need to respect that, okay? Let's take a look at an example and see what the calculation entails. So in example 2, we again have Bing Nap Ding Bat, and we've expanded the income statement to include the expenses and net profit. So we see net profit is $500 and net sales revenue is $5,000. So to find net margin, we simply divide net profit by the net sales revenue and multiply by 100 to express it as a percentage. In this case, it's simply 10%. So that's what it is. That's the value of the ratio. And it means that after covering all expenses, we have 10% of net sales revenue left that can go to the owners. Alternatively, you could say that out of every dollar of net sales that the entity earns, it has 10 cents out of every dollar left for the owners after covering all expenses, which doesn't seem like much, but again, not much compared to what? You might think 10 cents is low, but suppose for this company, 2 cents was the norm. Suppose this is a real good year. We don't know. Suppose it was 20 cents per year before. Well, now it's dropped. The question is why? We don't know. We're just spitballing here. Let me give you guys split tax to take a look at now, right? So this is one for you guys to try. So we have the same basic information, but now, oh no, I changed up something here, right? So I think it was 15 in the previous one was the gross profit, right? So I switched some figures just for a little variety. So I want you guys to take a pause, try the calculation of net margin for Split Tax Incorporated, and then take an unpause. How did it go? You got through with it? Okay, so all we have to do is put 4,000 over the 25,000. I believe that's going to give us 16%. Yeah, all right. So what this means is after covering all expenses, after covering cost of goods sold and expenses, this company has 16% of its net sales revenue left as profit that can go towards the owners. So now this is actually better than Bing Nap Ding Bat. But again, we don't have much information providing context. We don't know if Split Tax is well, it looks like a bigger company because it's earning more money, but suppose it was newer. Suppose it's using social media marketing way better than Bing Nap Ding Bat. Suppose Bing Nap Ding Bat was there for decades, and now with this new upstart and their use of social media, Bing Nap Ding Bat is suffering. We don't know. But again, that's actually, like I said, a double-edged sword. We don't know, which is a kind of bad thing, so we have the other side. We could kind of guess, we could spitball ideas and see what sounds good. All right, which is again kind of what they wanted to do at this level, at the CSEC level. Okay, let's take a look at the third ratio. Okay, so this is the operating expense margin. The formula is operating expenses over net sales revenue by 100 and expressed as a percentage. Now the operating expenses at the CSEC level are simply the expenses in the expense section in the income statement. The items between gross profit and net profit. Well, of course, after any non-trading revenues. So this ratio shows the percent of sales revenue that is used to cover operating expenses. Another way of thinking of this ratio, right, is that it shows how much of each dollar of sales revenue is used to pay operating expenses. It is often looked at as a ratio to assist with expense control, right? So the other ratio showed how much of sales revenue went to profit. This is showing not exactly the opposite, but the complementary thing, how much of it is going towards expenses, which is also, like I said, half of your profit equation, right? You cannot have profit. Well, actually, yeah, you could have profit without expenses, but just for the sake of argument, right? Profit is revenue minus expenses. So this also shows an aspect of profitability in terms of the item that decreases profitability. So you need to know, all right, how is this going? How is my control of my expenses going? Is the ratio increasing over time? Is it decreasing? What can I do to help it get better over time? Can I stabilize it? Can I actually decrease it? So again, all good questions to ask. And again, questions are important. Let's take a look at an example. So in example 3, we have again Bing Nap Ding Bat. I think it's the same exact set of figures. So we're just taking expenses and dividing that by net sales revenue, as we can see down here. Right now, I call it the OPEX margin because it's kind of tough to say operating expenses every time you talk about the ratio. So OPEX margin. So in this case, it's 30%, right? So what that means is that the entity uses 30% of its net sales revenue to cover operating expenses. Or, as you could say, you could also say it uses 30 cents out of every net sales dollar to pay for operating expenses. Okay, cool. What about split cookie tax? Let's take a look. So I'm going to put it up for you guys. So you guys plug in the figures, take a pause, take a read, try it out, let me know how it goes. Did you do it? Let's take a look. So for split cookie tax, we're going to put a $6,000 inside here. I'll put it over 25,000, and that's going to be 24%. Ooh, all right. So they're using almost a quarter of their revenue to pay for expenses, which is better than Bing Nap Ding Bat because they're using nearly 1/3, and a quarter is less than 1/3. So less of split cookie tax's revenue is going towards paying its expenses, right? Relative to Bing Nap Ding Bat. Again, maybe they have different organizational structures. Maybe they have different contracts with certain suppliers in place. We don't know. But again, double-edged sword. We could spitball and come with pretty good ideas, and we could probably put that to use in writing our analyses. All right, let's take a look at the last ratio, which is actually the most different ratio in this entire handout. Okay, so this is the return on capital employed or capital invested, or the return on investment. So if it's return on capital employed, the abbreviation is ROCE. If it's return on capital invested, ROCI. If it's return on investment, ROI. And that's a popular one you will hear. Now, the calculation is net profit or net income according to what you guys are accustomed to, divided by average capital by 100 over 1 equals, and it is expressed as a percentage. Now, first of all, you may be wondering, what is average capital? Now, hold on. Don't burst a blood vessel. You all did math. You all do math. You know what an average is, all right? An average of two numbers is you add them together and then divide by 2. That's all. So, for example, let's say you had 2 marks on tests. Let's say you had 80% on one test and you had 100% on the next test. Your average would be 80 plus 100 divided by 2, which is 90, right? So the average capital is opening capital plus closing capital divided by 2. Right, mystery solved, cool. Now, this ratio shows the net profit earned as a percentage of the average capital employed or invested. Now, I'll tell you something about myself. When I saw this ratio back when I was in Form 4, Form 5, I had no idea what capital employed mean. And it took me, I'll not lie, years to really understand. I honestly didn't understand these things at a fundamental level. I just memorized a lot. And only years later, when I had to teach it and I had to really understand it, I was like, oh, this is what this means. So I'm trying to communicate these things to you guys so you don't take years to understand things that you can understand in minutes, right? Now, sometimes it's okay to take years if you're really working at it and if it's something difficult. Other times, maybe we could speed up the process, right? Speed isn't always necessary, but sometimes it's nice, sometimes, right? Now, who is investing capital or who is employing the capital? The owner. Why? To make profit. The owner is putting in capital, and that is what the owner is investing in the business. If you think of another context for investment, you might think of that stuff like the stock market, or you might think of mutual funds, or you might think of bonds or treasury bills. You are putting money in this vehicle, and your money is expected to grow. And usually it's expressed, the growth is expressed as a percentage of whatever you've invested, a percentage of your capital investment. It might be 10%, it might be 16%, or ever since the whole world economic correction back in 2008, 2009. It's more like, 1%, 2%. In some cases, you might get a 3, 4, 5% if you're lucky. I haven't seen many rates higher than that. But again, I'm not really checking rates as a matter of, of course, for me. I kind of focus on teaching stuff, right? But anyhow, so what I'm saying here is that this ratio measures the owner's return on investment. The return is what you get back. Now, yes, you get back your investment, but you don't put in money. You don't invest in something to just get back the money you put in. You put it in to get back more money. What is the more money the owners want to get back? Profit, right? So it's taking the profit and expressing it as a percentage of the capital invested. Long story short. All right. So another way of thinking of this is that it shows how many dollars and or cents each dollar of invested capital earns as a reward. It is akin to an interest rate on an investment. So let's take a look at the calculation. Right, so we have Bing Nap Ding Bat. So we're in the statement of financial position now. Its opening capital is 10,000. Closing capital is 9. We have net profit was 500. We have drawings of 1,500. Okay, cool. So the calculation is the net profit, which is 500 over average capital. What was average capital? Opening capital plus closing capital divided by 2. 10 and 9 is 19. 19 divided by 2 is 9,005. Right? So you express it, so you're going to get about 5.26%. Now, just very quickly, if in a question you do not have opening and closing capital, you only have one or the other, that's fine. Just use that figure. And if you have to calculate multiple instances of that ratio for multiple entities, make sure you use a consistent formula. Don't use one formula for one. Let's say you had average capital for one and then closing capital or opening capital for the other. You would be comparing inconsistent calculations, which will then render your comparison and whatever else you do after that meaningless. So always be careful. As they like to say, compare apples with apples. All right? Compare like with like. Now, this right, so the above calculation shows the return on capital employed is approximately 5.26%. So this means that the owner's investment, the return on the capital is about 5.26%. Alternatively, it can be said that out of every dollar of capital the owner invests, the owner gets back an additional 5.26 cents. So if you invested $1, you're going to get back $1.0525 approximately, right? Okay, so let's take a look at Split tax and see what's going on there. So I'll let you guys calculate the return on capital employed for Split tax. Did you do it? Try it, make sure you try it. The only way to learn really is to do. You have to do. Okay, so the net profit is 4,000. So we're going to put 4,000 on top there. And the average capital is opening capital plus closing capital divided by 250, and 52 is 102, half of which is 51, right? Now, the percentage would be 7 point something, right? 7.84 approximately. So you could round off to 2 decimal places, if anything, right? So Split Tax Incorporated has a return on capital employed of approximately 7.84%, which in this case is better than Bing Nap Ding Bat. Again, we don't know why. We don't even know the two companies are comparable. Are they in the same industry? Are they the same size? Are they the same? Have they been around for the same length of time? We don't know. All right. We could definitely see that Bing Nap seems to be a smaller company than Split Tax. We don't know why. All right. But again, comparison needs a lot of context for it to be very meaningful. All right, so ladies and gentlemen, that has been the profitability ratios that you should need for the CSEC level PoA. Again, if you take a look in your syllabus, you will see in section 5 specific objectives, I think 5 and 6 or 6 and 7, somewhere around there, that they have two categories of ratios, and under profitability they have net margin and gross margin, and they also have rate of stock or inventory turnover. Now, I don't know that one is a profitability ratio, and then if you go to the CAPE syllabus, that ratio is in the efficiency or activity ratio section. So I'm teaching it as I know it, right? Now again, sometimes people have different variations on formulae. So if you guys use a different formula, please comment it in the comment section below, and I'll take a look at it. Again, I'm very open to learning new things, right? Sometimes you all will know things I may not, and that's quite okay, right? Anyhow, if you guys want to check out any more videos, I'm going to put some cards up here. Don't forget to subscribe and to click the notification bell so you know every time I release a new video. Don't forget to check out my website to download some free PoA handouts. And until next time, guys, thank you so much for watching. Take care of yourselves, and I'll see you next time. Bye.